Hey everyone, this is Kirk here again at Option Alpha, and this is the video tutorial for the head and shoulders tops. So we're going to be talking about the head and shoulders top chart pattern and how to trade that and some of the particulars that you want to look for when you're going through and searching your charts and finding this pattern, and really is it worth it to trade it, some of the nuances that you may not have seen elsewhere. So we'll get right into it here as always. So the chart pattern itself is pretty complex, and we're going to go through it here in detail. And what I find a lot of people doing when I'm doing coaching one-on-one with students is that they try to find these chart patterns without actually identifying the major features of them. So they create patterns that aren't even really there. And then another big thing that people do is that they actually don't wait for the pattern to complete. They just kind of let the pattern go halfway, and then they anticipate the pattern completing itself. So it's important here on this video tutorial that I go through exactly how the chart pattern forms and when you should make the trade. So as we talked about before, the head and shoulders reversal or top is that it has to follow an uptrend. So we can't have a reversal or top at the end of a downtrend. It has to follow a long sustained uptrend. Now I talk about an already sustained uptrend. I'm talking about something that's been going on, a stock that's been rallying for consecutive months, even consecutive years. We're not talking about a stock that has seen a 30-day blip higher in the middle of a long downtrend. That's not an established uptrend. So we want a long established uptrend leading to the first left shoulder. Now, of course, you're never going to see the first left shoulder and then see the whole chart pattern. So you have to watch it evolve. But after a long uptrend, we're going to have a short market top. The market's going to come down and bounce off of what will become the neckline. And then it's going to rally again, and it's going to seem like it's still in a very strong uptrend. And that's because we're breaking out of the previous highs, or this left shoulder here, and establishing a new high, or this head of the pattern. So at this point, it doesn't look anything like a head and shoulders top. It's just going to look like an already established uptrend. Higher lows, higher highs in the stock. But then after the head forms, it's going to fall all the way back down to the neckline. So this is going to be the first scare for some of the bulls, is that this trend may be losing some steam, because now we're not putting in higher lows, but we're putting in even lows. And this is where the neckline gets established, right after the market falls away from the head. So now we have a stock that's bouncing very, very similar in a similar area to where it bounced before establishing the head. The stock is then going to rally, but it's not going to make it quite up to where the previous head is. So it's going to form this right shoulder. Now, ideally, these shoulders should be similar in height and similar in duration. So this left shoulder shouldn't take 4 months to form, and then this right shoulder takes 10 days. They should be fairly similar in how long they take to form and fairly similar in how tall they are on the chart. But again, the idea is that the stock is going to rally, but it's going to fall short of reaching the previous highs, and that's when people are going to start really coming in and selling it hard, which is where you get the breakout. So after the right shoulder forms and the stock fails to regain the highs, the stock's going to fall, and then it's going to break the neckline. And that's the most important part of this entire pattern, is that you have to wait for the breakout. I know a lot of people who are trading the S&P and the Dow and the Russell and the NASDAQ a couple years ago, and they didn't wait for this breakout, and they anticipated a market top. And what actually happened is that the market came down and almost broke out, and then went on to multi-year highs. So you have to wait for this breakout. It's got to be a clean break of the neckline, and that's the most important part of this entire pattern. So as we get into crunching the numbers, as we always do here, the average rise or decline is about 22%, and this should be a negative. It's negative 22% after the breakout. So on average, these head and shoulder tops after a successful breakout will yield about a 22% fall. The breakout failure rate is very, very small at 4%. And the reason it's so small is because you have a chart pattern that takes a long time to form. It's a long change in psychology. And once that change in psychology happens, then it's more prevalent that the market's going to continue lower. Once that breakout happens and we've really exhausted all of the buyers, then that breakout is really going to accelerate downward. So we do actually have a very low failure rate after the breakout. So a lot of people who are trying to trade the indexes and anticipating a breakout didn't actually see it, because they didn't actually see a clean break, or they would have gone in at that point. The throwback or pullback rate is about 67%, so very, very high on this particular chart. So again, we'll go back here, and the throwback or pullback, what I'm talking about is that after the breakout, the market will come back up and retest that area or that neckline as previous support. It's now going to retest it as resistance. So it's going to seem like the market is again gaining strength, but it's going to fall short right at the neckline. So it's very likely that the market's going to come back up. About 67% of the time it comes back up to that neckline and retests that area. So as an option trader or as a stock trader, this is actually really welcome. If I was trading this chart pattern, I would actually just let the breakout happen and try to catch it on the retracement or pullback. I think that that's the smarter way to play this. Don't anticipate the breakout, of course, and don't try to chase the breakout lower. Wait for the market to come back up and retest that area or that neckline as new resistance going forward. So some key points to remember with the head and shoulders top. An already established prior uptrend has to be in place for this pattern to be relevant and reversal. So like I told you before, this cannot form in the middle of a downtrend. It has to form at the top of a long sustained uptrend. Volume during the first half of the pattern is less important than in the second. And basically what I'm talking about in this is that we like to see some volume confirmation on the breakout. We like to see declining volume through the first half of the pattern, and then as we start to get closer and closer toward the breakout point, increasing volume, signaling that more and more people are hitting the exit doors, which would really confirm a big market top. The projected price decline is found by measuring the distance from the neckline to the top of the head. So once we get a confirmed breakout, if you measure the distance from the middle of the neckline to all the way to the top of the head, that is usually about how far down the market's going to go over the course of the next weeks or months when the stock falls. On average, it's about 22%. So if you see something that's a little bit larger than that, if you have a measured move of about 35%, then you may be looking to take profits around 22, or at least starting to cover some of your short positions. Hey, thanks for watching this video from Option Alpha. As always, we invite you guys to come back and check us out at optionalpha.com. And if you like this video, please share the video with any of your friends, family, or colleagues on your favorite social network.